take a step back and you look at just the interest rate market, fixed income, the month of February, we saw a rally across Treasuries, EGBs, gilts, and JGBs of 20 or 30 basis points. And in our mind, that was largely over-hedging and risk management around whether it was AI fears, private credit risks, or the potential Iran war, which actually did come to fruition. But rates markets were overly long, and I think that made them susceptible this week to the sell-off that we saw when energy prices spiked. You look at the Bank of England, we had almost a full cut priced into the March meeting. So right. This was extremely disruptive, seeing what happened in energy markets and the flow-through effect to the front end of interest rate curves.
I recall 4.13%, the blue Detroit Lions button, excuse me, 4.13%. You and I were looking, what, 394 at one point?
Yeah, exactly. Are you surprised that I guess, are you surprised we haven't seen a bigger move in the rates market?
It's been very well contained. Yeah, I mean, we're talking about a 20-bit move with massive geopolitical risk, massive risks around just kind of the AI and private credit narratives that are out there. So for all intents and purposes, relative to energy, equity, and vol markets, rates have been pretty well contained. So I think that's a fair point.
I mean, we're going to get another economic data point tomorrow, change in non-farm payrolls. What's your market looking? What's the Treasury market thinking here?
We still think this is an extremely important piece of data. Probably more important for the Fed in the near term than even what's going on geopolitically right now. There's been plenty of Fed speak of late talking about concern around softness in the labor market. And for us, whether we get the 85K print we're looking for, I think consensus is around 60K down from January peak. We still think that this is the one side of the mandate that the Fed is more focused on right now.
Okay. So given that backdrop, I mean, I guess the pre-Iran, the market was looking for one, maybe two rate cuts. I don't know if what's happening in Iran changes any of that, but probably it's more the data, as you suggest. Is that still a reasonable expectation for this market, 1 to 2 cuts this year?
For us, those cuts are still very much in our scenario, but it's post-Powell regime after we get that handoff at the Fed. So,
are we going to get that handoff at the Fed?
That's a great question as well. I don't know if we have enough time for that question, but in our mind, I think those cuts are still very much back half of 2026. In the very near term, the data has held up surprisingly well. And the growth data, recent GDP prints have been on the strong side. So it's hard to see us really getting an ease in the next couple of meetings before that transition.
We kind of joke about whether we're going to get this confirmation hearings for Mr. Warsh, but if that does turn ugly, what's that mean for the Treasury market?
Well, I don't think it's a positive sign, but I think really the other question around those confirmation hearings is, at the same time, what does that mean for Jerome Powell and the potential transition to staying on as a governor or not staying on the Fed?
Yep.
So clearly we have to see how this investigation into his time at the Fed turns out. I think that's a big X factor right now. We have to see what his intentions are, whether or not to stay on at the Fed in the governor role. All of these things are moving parts that we're looking at right now around the Fed.
From a trading standpoint, if people quote unquote stepped away in the last 6 days, what's the actual behavior you see on your screens, on your telephones at Nomura?
Yeah, it's been in the risk off move. It's been a degrossing story. It's been an unwind story, and I touched earlier upon the unwinds that occurred in the rates market, whether it was the front end of the sterling curve. Equity story is pretty obvious there as well. In the inflation market, I think we had gotten into a regime where people were acknowledging left tail risks and really ignoring the right tail risk to higher inflation. That came back and really caused some pain in markets as well. And I think the last thing was really in vol markets across asset classes. Everyone kind of got lulled into a sense of complacency, and vol markets across the board reacted in a pretty aggressive way to the start of the week. We saw a little bit of a reversal yesterday, but that's something to keep an eye on right now.